One of the advocacies we have is education, and specifically on Social Security. We want people to understand their options so they can receive their optimal benefits. We get really excited if we can show you how you end up with more money from Social Security than they wanted to pay you. To accomplish this, we start with an understanding of what Social Security actually is. We can't think of it as being a government program that we start when we want and when it's convenient. We need to look at it as what it is. It's an investment. And we want to manage it like any other investment, which is to maximize our returns. What if I told you that I have an investment, you could give me your funds, and in 1 year I would increase it almost 11% without any risk of loss? It would have a tax break over other investments, and you'd not only benefit from the increase, but you'd benefit every year as long as you live. Wouldn't that be attractive? Actually, if you have anything better, please let me know, because I have funds I'd throw into it. Just like you have a bank account or a brokerage account, you have a Social Security account. And its basis for your benefit, and in 2026 alone, it increases 8% by waiting a year, plus it has a 2.8% COLA, which increases your account 10.8%. And when you receive your benefit, it's always at least 15% tax-free, because that's the most we ever declare for federal income tax is 85%. Thus, the account benefit not only increases attractively, but the income we receive will also provide us better than the income we receive in comparison. And an example would be receiving $30,000 from Social Security, but it's equivalent to receiving $3,000 or $4,000 more, because $4,500 of that would not be subject to income tax. When we refer to Social Security as an investment, it's basically an investment annuity. Your account is called your primary insurance amount. And just like a commercial income annuity, you want to maximize your return. If you went to an insurance broker with funds and asked for an annuity, you'd want to know the formula for accumulation of the account before you start to receive your income. Then you want to know the size of your payment and calculate how many times you'd receive that payment, and that's your payback. With Social Security, you'll have a payback even before 78, whether you claimed at 62, 70, anywhere in between. When you look at the new numbers on your Social Security statement, that looks like it's about 81 years to break even. But they don't consider COLAs, which they're going to compound. They don't consider the extra value of your money based on a 15% tax benefit. When we consider those, your break even is less than 78. Now, typical actuarial table for people in their 60s in good health would have a man's life expectancy between 81 to 85 and a woman's life expectancy between 85 to 89. We can make a big mistake by looking at Social Security as a convenient means of benefiting for a few years, but costing us so much more later. Now let's look at a comparison of Social Security to other investments. We love this slide because it reflects that we have options and we should carefully consider which horse we ride. We find that many people are reluctant to use their 401ks or IRAs because they built them up over 35 to 40 years, and they always felt it would pay less taxes after their income stops. That's not always the case. As an example, let's say that a couple has about $1 million collectively and they're 65 and retiring. Many times the advice they receive leads to a plan to live off Social Security and pensions and other savings, hold off on paying taxes as long as possible. But that $1 million at 5% additional growth will end up being over $1.6 million in their RMDs. That will be over $64,000 they have to take each year, which will be added to their Social Security, pensions, interest, dividends, capital gains, likely to push them to a higher tax rate in the future based on their existing rates. But our rates are almost certainly to be higher in the future based on our deficits and shortfalls, even more than we're projecting. We are encouraged by our advisors to keep our funds in our accounts, of course, through the ups and downs, because we feel that no matter what taxes we'll need to pay in the future, we'll better if we just let the top line grow, and any tax we pay will always have a greater amount in between. Let's look at this in a different way. What if we have $100 today and our tax rate is 15%? But we look at our future tax rate when adding the RMDs, and we could project being in a future rate of 25%. To make the math easy, let's just say we look at $100, doubling to $200 in the future, and it could be 15 years, the time doesn't matter. If we will pay 25% on that future 200, and we pay $50 in taxes, we're left with $150. What if we pay our taxes at the current rate of 15%? We're left with $85. But if we make the same investments for the same period of time and nothing changes, our 85 will double to 170, not 150. We end up with more money because we did a tax wash or a tax harvest. We pay the taxes when they're lowest. Now, hold this together with Social Security. We always do at least 10-year income projections as part of a Social Security strategy. Allows us to see the tax levels we'll have each year. And we commonly find that delaying Social Security is not only better because it's a better investment return, it also allows us to wash tax out of our retirement accounts, which we can do so at a lower rate. We pay the taxes when they're lowest. Another reason to take the time to make a detailed plan for Social Security, it's also much more complex than we're led to believe. As an example, there are 567 different variables that can affect your benefit. That's beyond age claiming options. You need to employ a professional to help you develop the best Social Security strategy. That includes a holistic approach that includes the specific assets and the objectives, and they're different for everybody. We at Fourth Quarter Advisors are advocates who simply want to educate and provide information, allows our clients to make the best decisions for themselves and their families. That's our focus first and foremost, without pushing anything based for compensation for us. It would be a pleasure to discuss this with you and hopefully help you win your fourth quarter.